Okay, so it's a weekly Q&A. And just by the way, this will be the last Q&A ever because we renamed this to be a strategy call. So what we're going to be doing as a new rhythm is on the Friday with myself, we're doing a wealth strategy process. And then on a Wednesday, Alex is going to be doing accountability in terms of the process. And we're also going to be doing a deals update with the CIO. So just to let you know, that's what's happening. It doesn't really change the format. It's just a naming convention. So yeah, that's the weekly Q&A. And just a reminder, I'm not going to be giving out financial advice, just basically trying to share with you my knowledge, my skills, my lessons, etc. So I've got some questions for everyone today. And we've got a new structure that we're going to be implementing over the next week or two. And that is that we're going to actually have an environment for people to ask questions before the event. So we're working, Shane, I see Shane just joined me. We're working with some American partners at the moment that are very, very efficient and effective. They basically, what people do is they fill in a Google Sheet and then people can pre-ask questions. So that's wonderful because not only does it allow me to prepare, but it also allows people to participate and to ask questions going forward. So Shane, I know you just joined us, but maybe you could give us a little bit of guideline as to how you see that process working in terms of going forward and how people are going to be able to ask questions. And, you know, basically, I'm just wanting to understand from your perspective how you see the rhythm working. You can see you got your camera and audio off. Are you with us, Shane? There he is.
Scott, sorry.
Well, I'm dropping you completely in the deep end, but I've been in London for a week and then Joburg and then Cape Town. I know you've been doing a huge amount of work with the team and sort of heading up the project. And I just wanted to understand from your perspective how you see this rolling out in terms of people being able to ask questions. When do you see us actually implementing it effectively?
Yeah, so it should be up by next week. So effectively, there will be a form when you go to the calendar event that you can fill out. And then those questions will be submitted through. And then from there, we can just make sure that we have those questions ready for you, Scott, and then prepare if need be. So, yep, next week.
Awesome. And I think what we're going to do, obviously, you know, mastermind members and wealth hackers get priority in terms of being able to ask questions. So that's so it's really just a case of like anything you want to know, and then I can come along. And even if you can't make it, it doesn't matter because it's recorded, etc. But it's really a system that Shane actually found these partners out of America, and they're really good partners. They've got really efficient systems, etc. So we're just wanting to emulate the way that they're working in terms of that process. So anyway, we'll so effectively next Friday will be the last. Well, as Shane said, we're going to be getting it going next week. So effectively, you know, going into March, it'll be the updated system. So today we have a less efficient system, and it's going to be called the chat box. So Frankie, I can see that you here, Kathy, you here. Shona, I know you were there on Wednesday night at the Mastermind fireside chat. Alan, I'm not sure if you were there. There's a couple of topics that I wanted to kind of talk to, which I think are relevant. So the one is, and again, Shona, I apologize, but it'll be repetition for you. But I was to kind of talk through what I found on the ground in London, specifically the area, the opportunity, etc. So that's the one. The other one is the American opportunity. And the Manhattan deal has literally launched now, so people have access to Manhattan. Every time I say that, I have a smile on my face because it still feels too good to be true for me as much as everyone else that you can now invest in Manhattan. I just think it's unbelievable in terms of that process. I know, as an example, Alan was asking some questions about the wealth weekend, so I'm happy to talk more about that. And if you don't know, as a wealth hacker, we've actually extended the invitation to the wealth hackers. So as an example, if someone was keen to come and join us, you know, we can send you the details. You just let us know. So the question I've got for you, and this is a bit of crowdfunding or crowdsourcing or whatever word you want to call, is I'd like to answer any questions anyone's got. So if you've got any questions, just chuck them in the chat box. I can see we've got about 5 AI people following us. So whatever happens, this call is recorded because there's about bloody 7 systems recording it in terms of that process. But I'd like to kind of start, as always, with, are there any questions, anything that I can help with, any direction? And then on top of that, I'd love to know what you'd be interested in. And by the way, we can do all of them. I'm interested in where people want to start. So we've got London. I can talk to London and kind of the area, the opportunity and everything else. I can talk to Manhattan and what's happening there. I can talk to the structured notes that we did with Chad and the mastermind members on Wednesday. And I can also talk to the Wealth Weekend. So we've got, and probably a fifth one would even be Clem Santa, which is coming up in a week's time or so. So please type in the chat box what you're interested in. I know all the information. I know I'm being arrogant and I apologize, but I know it also. It's what do you want? What do you want me to share? What would be valuable for you? I'm trying to get into sense as to where people want me to focus. Is the chat box not working? I don't see any messages coming in. Oh, there we are. Okay, Neil's asking for an update on CarryFit. Okay, perfect. I can do that. Anything else? So I'll answer that while we're waiting for the others. Neil, so I was talking with Glenn, sure, today's Friday, would have been early this week, Monday actually. They're closing out the next tranche on the 28th of February, so literally in a week's time. And we're part of that tranche. So we're closing out with them in that tranche on the 28th of Feb. I assume that answers your question in terms of the process. And again, Niels, what we're going to do just going forward is we actually, every 2 weeks, we're going to have a deal-specific session like this. And my CIO is actually going to be with me because then we just believe it'll be far better from a transparency perspective. But yeah, if you could just type in the chat box there, Niels, if that's what we wanted. To the rest of you, to Frankie, to Craig, to Kathy, to Ellen, to Shona. I know Shona knows everything I just mentioned because I spoke about it on Wednesday night. But to the rest of you, what are you interested in? Do you want to know about London? Do you want to know about Manhattan? Do you want to know about structured notes? Do you want to know about the Wealth Weekend? How can I help?
Okay, can I ask you a peculiar question?
Go wild, Alan.
Okay, with regards to investing and new diversification, I just want to ask this question. You may not be able to answer it. All my investments everything I've got are totally in the United States, the US, except for a flat in London. And my question is, I know it's very difficult, but whatever, you've got the best people to ask instead of me phoning around and checking it because people just bullshit out and whatever. What's the chance of Trump freezing, like just take Alan Ross, and the thing comes out from him, you've got investments, South Africa, you've got investment overseas in the United States, I'm freezing your investments until whatever. I don't know if he would do it, but I have had experience like in Zimbabwe where it was done and my money is gone or held, whatever. I don't say you would take it, but freeze it. I don't know what your company's view of this is, or Callio's view of it, because like that Manhattan thing you're doing, I'd love to go and invest in, but I've got no property in the US. I've got hundreds of rands of shares and whatever. And I'm saying, here, I'm going to go and put more money into Manhattan. The next minute he freezes it. I'd rather go to London to put money in property. Just a question. I think it's a vital question. I know it's not easy to answer, but you don't know what's going on, what goes on in the world. So the question is Trump ever likely to do that, or am I just talking nonsense?
No, look, I think it's an interesting question, Alan. You know, the one thing I'll give you credit for is I've been on stage for over 20 years, and I always find it intriguing when I get asked a question I haven't been asked before. So, because normally most questions you've been asked before and whatever, but that's a new one. Look, so I don't have any, in a similar way to none of us would have been able to spot any black, they call it a black swan event, like a COVID or anything like that. My gut feel on it is the chances of that happening are 0.00001%. And I'll tell you why. I mean, obviously in life, nothing's ever impossible.
No.
But the point being is that, like, America is a capitalist first country. So I've had the privilege of doing work in many different places. And like in Australia, if you're not Australian, like, they don't take you seriously. In England, they've got their class society. I know there's a couple of people in England who know exactly what I'm talking about. And depending on where you fit in the class, you know, it depends on who they'll work with or not work with. And, you know, people think that I'm talking rubbish, but I mean, I've literally experienced this myself, you know, in terms of that process. Whereas in America, it's a very different place. You can be green, black, blue, yellow. It doesn't matter. If you've got money, that's all they're interested in terms of, it's a very capitalistic environment. So I can't see how or why he would do that. Now, let me give a caveat to that. In England, they did freeze the Russian assets. So that Abramovich owned, I think, Chelsea, and they literally froze the assets. Was it Chelsea? Which club was it? It was. I'm sure it was Chelsea. And you know, he's a Russian billionaire, and you know, and they did freeze the Russian assets when they set the Russian embargo with the whole Ukraine war and whatever, and that a couple of years ago. And so it's definitely happened to the Russians. Just to be clear, to my knowledge, it didn't happen in America. It only happened in England and Europe. And most of the Russians, not most of the Russians, that's a stupid comment, but many Russians, so 10,000 Russian millionaires actually moved to Dubai. So they went to live in Dubai because the people in the UAE just said, hey, come, we love your money, no problem, like in terms of that process. So to answer your question, Alan, I wouldn't see him doing that because there's no benefit to it. So you and me are investing in Manhattan. We're stimulating growth. We're stimulating jobs. You know, we're growing the economy. We're not doing anything to the detriment of the economy in any way. You know, and so that would be my take on it. I mean, again, I know the Zimbabwe situation. I have 3 farms in Zimbabwe still, so I know exactly what you're talking about. That technically we own on paper, but I personally can't see it. I can't see it happening at all. You know, unless we, you know, like as an example, if Japan went to war with America, I'm almost sure in 1941 or whatever, Japanese assets would have been frozen. I'd have to actually research that, but I'm almost willing to bet you they were. But unless you're going to war with America, I doubt that's going to happen. And with all due respect, I don't think South Africa's going to war with America anytime soon. So that's
all right. No, yeah. But I think it's an important question just to view. You know, you never know because of this, the politics in this country and the people. So I just wanted to just get an opinion on it.
No, I think it's valuable. I'll send Anthony a message. I'd love his take on it as well. You know, I think it is one of those things where there's probably more chance of Russia bloody sending a nuke over and blowing up Ukraine, quite frankly, and what would be the impact on Europe, and like just by feeling like, I'm also saying that's a 0.000% chance. But the point being is that I don't see America freezing assets personally. You know, certainly. And the other side of the fence that I would go with is that it's one of the reasons I like investing alongside Calio and other family offices, because we're not doing it. We're not like out on a risk all on our own, if that makes sense.
Because while I asked it, you know what he's done with the AIDS support? I mean, he just cut that off overnight. Never. Yeah. And,
so I mean, it's really interesting because I've got some friends that are directly impacted. You know, one of my mate's wives I literally saw on the weekend. And I mean, she's in rhino poaching. So it's not only AIDS, by the way. And her whole project has been shut or is getting shut down because of this process. There was another gentleman who's actually on our mastermind, Chaz, that was, you know, he's got factories in Swaziland. And I don't fully know how he's been impacted, but it's impacted him as well. So I hear you. I just think that's the other way around, though, if you think about it. And again, I don't really want to get involved in politics because no matter what.
But it's a very important, it's not politics, it's cash flow, money.
No, I agree with you. Sorry, Alan, what I was about to say was, I think the perspective from an American taxpayer is we pay $1 in tax. Why is that going off to Africa in aid? Is the kind of the logic. Does that make sense? You know, whereas in this case, every country that I've ever met, foreign direct investment is a critical part of what countries look for. So I'll tell you a funny story. In 2004, I was on stage in London representing South Africa. So I wasn't representing my company, I was representing South Africa in terms of helping people in England invest into South Africa. And someone actually asked me, they said, what is the FIDR? And I was like, what the hell is that? I didn't even know what the acronym was. And, you know, I was live on stage in front of 200 people. Anyway, I found out it's the foreign investment, it's foreign direct investment, basically, FDI, foreign direct investment. And it's a critical number that countries follow because they want investment coming into their country. And So by freezing assets, it would go completely counterintuitive to that. But I will send Anthony a message.
Okay. And then I've got your conference in Nasna. I've got all the emails, all the details. Probably the lady sent them through to me this morning, so I have them.
Cool. Okay, awesome. Yeah. I mean, in simple terms, not only for you, Alan, but for everyone else, everyone's going to arrive kind of Wednesday around lunchtime-ish. We allow for travel, so people can fly or drive or whatever. And Garth and the team and everyone will be arriving around, let's call it 2 o'clock on Wednesday. We'll get started on Wednesday, late afternoon around 4 o'clock. And we basically set the scene for the first 2 or 3 hours. We'll have dinner on Wednesday night. Then on Thursday, we have a full work session. That's actually being handled by Garth and Karen in terms of the whole Enneagram and wealth and the AMCs. And it's really, really exciting day that's been put together. And then on Friday, we're going to be looking at things like generational wealth, technology, some of the movements. So there's a whole, I mean, it's a lot of that's in that agenda already, but I'm just letting it, you know. And then on Friday evening, we're going to have some fun. And then on Saturday, it's actually a social day. So we've got a boat cruise organized on the Nice Lagoon, etc. So we get to copy what worked in August, which is, 2.5 days is kind of work with dinners. And then the third day is a bit of fun in terms of connection.
So it ends Saturday night.
Saturday night, Sunday morning, yeah. I mean, it's
Sunday morning.
Yeah.
Thank you.
But Saturday is a social day. If someone said to me, one of the ladies in the mastermind has to leave at lunchtime on Friday, and I said, look, if you want to come to the working side of it, it's Wednesday, Thursday, Friday. Saturday is a social day.
Thank you.
Cool. Awesome. Okay. Right. There's a question here from Niels. Niels, you got your hand up. Do you want to ask the question, or do you want me to read the question that's in the chat box?
No, I thought maybe just ask it. If I'll try in my video, although I'm traveling, so it might the signal fails. I'll turn it off. Yeah, it is relating to the Manhattan deal. Maybe firstly an operational type question. Some of us have invested in the existing tranche that I think now it seems matures close to June, which was what 12 to 18 month deal.
It was always a 12 to 18 month. Yeah, so it's effectively on the 18 month is the maturity of that.
Perfect. And then, so how do we just operationally, how do we choose what to do with it? I think as Garth said, you must choose whether to stay in the deal or get repaid.
Yeah.
So on the platform, how do we choose, or is that done outside of the platform?
It's a great question, actually. So on the platform, we don't have the ability for Niels or Scott to go, hey, I want to exit the deal. Like, does that make sense? So we're going to have to do that in a more manual way. This is an unusual deal for us because normally you invest, the deal closes, you get paid out. You don't kind of roll over into a second deal, if that makes sense. So what we're going to do, Niels, to answer your question, is there's two things that are important here. One is that we've got an allocation. So we put $500,000. When I say we, the collective we, put in $500,000 into the original deal. There's so much demand for the deal that we can't get any further allocation. So what they're doing is they're allowing the original investors first choice, but they're not allowing new investors to come in because it's already oversubscribed. So what we've basically said, and I'm just being transparent with you, we've said we're good for the full 500. Like, we're going to commit to the new tranche for the full 500. If Niels wants to exit, no problem. In June, we will then, that's why we've already started with the new raise, if you want to call it that, because then if Niels wants to exit, no problem. Niels can exit plus his return and everything else. And if Niels wants to stay in the deal, he gets first priority before anyone else. Does that make sense?
Yeah, so just offline, we must just let you, if we've already made a decision, then we'll just let you know offline.
Yeah, it's something that, to be honest, I've really, with the team, we've been focusing on getting the deal live, both the hybrid. We still have to get the other two ones, the equity and the debt, because we really want to get an idea in terms of the market demand, what people want. Like I told you, this is one of those situations where it's I mean, $500,000 sounds like a lot of money, but it's actually really not a lot of money in the big picture of things. And so there's a lot of urgency, and we basically want to hold our corner. I don't know if you've heard that statement before, but it's where you hold your tranche, if you want to call it that. But we will, I mean, there's a bit more time before now in June. We'll make sure that we get hold of every individual investor, give them the option, do they want to roll over? Do they want to exit? It's whatever they want, we can facilitate, and we will do that, but we just wanted to get these deals live quickly.
Perfect. Okay. And then if you want to put additional in and you want to register that intent, do we have to fund the wallet now if we're looking at and therefore leave the funds there between now and June, if it's June, because obviously that becomes idle cash.
Yes.
Or can we register intent and fund the wallet later?
No, so we've actually we've thought through that, because there's one gentleman that's part of the mastermind that does want to exit, and he was quite a lumpy investor. He's got 200,000 in, and so we've actually done a deal with him where we'll just take him out. So so let's just say Niels comes in and Scott goes in now. We'll take him out, and then we'll earn the return.
Okay, so if we fund now with new cash, we will get the return associated with the debt deal that's in play now.
That's exactly it, because I mean, he was comfortable exiting after 12 months, and so we were like, well, cool, we'll just buy your tranche out, if that makes sense. Yeah.
Okay, so it won't be idle between now and the next deal going live. Okay,
correct, and that's exactly why we've launched it now, because we've got that opportunity.
When is that likely to help me understand? When is that, if we fund it now? Sorry, it's quite an operational question, apologies. But if we fund it now, when is the interest, like on the new portion, when is the interest going to start accruing?
So it's an interesting question, and I'm going to struggle to answer it. So I'll try my best. Okay. So remember, so this gentleman's case, we're going to take out the 200 tranche. Okay. Ideally, we would do that either in two tranches of 100 and 100, or even better, one off 200, give him his return, and we own that space. It really comes down to, obviously from a mastermind perspective, we told people it had gone live, but we haven't even done a launch yet, because we want to get the debt and the equity live in terms of that process. So Niels, my logic would be, realistically, and just to manage expectations, I would say we will launch and raise for maybe 3 to 4 weeks. And then once it closes, the nice thing in America, everything happens quickly. So, a week or two, and it should roll over. Remembering that the interest on that deal, the Manhattan deal, is paid quarterly. So we'll just have to time it. And actually, it's a great question, because I don't know the answer to it. We would have to just figure out when that timing is. And I'm going to take a guess. It's a wild guess, but I think it might be April. And then that would actually be a perfect, is the right word, or am I trying to sound too clever, juxtapose, where we buy him out, he gets his interest, and then we own it going forward,
Okay, great. Thank you.
I will check on that, because I definitely know it's paid quarterly. I just need to know whether it's March or April. It's around this time, but I just need to know when it is, because that would be perfect. Because what you don't want to do is work out 2.3 months and you owe this, and we it. Do you know what I mean? It gets messy.
Yeah, absolutely. Okay, cool. That was. I was interested in whether you were going to do the equity only deal, although I've probably decided personally not to do that one, rather the hybrid. But but I think you've answered that now and said that you are looking to see if there's any interest in that.
We're going to do it because a couple of people have said that they might be interested. And, honestly, in the game we're in, give people the option. There's no downside, if that makes sense. I will caveat, though, if it's a pathetic amount of money, I don't know, $20,000, $50,000, then we're probably going to say, hey, look, let's roll it. Because what the partner on the ground is not going to do, they want to do tranches of at least 100,000 or more. Do you know what I mean? So they're not going to do an equity tranche of 25K. I just want to manage expectations. You know, that they won't do it. They'll just tell us to piss off. I mean, they're used to dealing with people with minimum investment of 250. So they won't care if we want to do a 25K equity investment. They just won't. I promise you they won't. Like,
cool. Okay, cool. Yeah, that was a lot on Manhattan. I think it does sound like a good opportunity.
breaking up a little bit. I'm trying to listen, but is there?
I just moderated the conversation, so I don't know what else other people want to talk about as well.
Okay. Okay.
Cool.
Cool.
I said I wasn't it's trending in terms of I'm interested in that. If we can talk about that as well, the London one you were talking about.
Okay. Cool. Okay. Well, let me. So Craig said the London opportunity as well. So okay. So let me pivot to that. Any more just before I move on? Any more questions around Manhattan? I do actually need to make a note here because I've got 2 jobs to do as a follow up here. So let me just write this down. So one is speak to Anthony, and 2 is speak to Paolo about timing of quarter. Yeah, perfect. Got it. Any other questions around Manhattan? Just for the record, let me go and show everyone here. Let's do that. Come on, man. Oh, damn it. I'm going to have to stop sharing screen. Sorry, I was going to go get my password. Nice to know we've got security, but sometimes it irritates me. This is like forgotten my details. Okay, so what we were just talking about here is the Catherine Street deal here, and you know you can literally go along and look at it. Everything's here. I have also have they put it up yet? I did do the video for the mastermind people. Okay, I'll have to follow up on that because I asked them where I did the recording with Garth. In fact, I need to write that down. Recording with Garth. Upload to Transform. You can go read all about it. You can see the risk category here in terms of the value add. You can download the brochure, and obviously you can read through everything in terms of this process. In simple terms, what you're looking at in the blended is you're getting a blend of the capital growth and you're getting a blend of the cash flow. So obviously the debt has a higher cash flow but no capital growth, and the capital growth has capital growth but no debt. So it's a blend of the two. It's a 7-year investment because if you put in $100, $50 is going into equity, $50 is going into debt, and the equity component is 7 years and the debt component is 4 years. So that's why the blend would still remain at 7%. 7 years, sorry, 7 years in terms of the total. But yeah, that's the opportunity. It's currently live on the platform with the blend. We're just waiting for the equity and the debt to be on the platform as well. And then we're going to do a full launch, which will be next week. Okay. Any questions? I just want to see if there were any other questions here with regards to Manhattan. Okay. So let's go to London. I think that's perfect. Okay. So what I want to start with here is location. So, and Shona, I apologize. You've heard this. I'll let you do this part of the presentation. No, I'm joking. No, but on a serious note, I lived in London since 1999, and I started investing in London in 2002. And one of the things that I learned is that there's a couple of things here that are actually quite important around UK property and specifically London property. Now, no disrespect to anyone that's invested outside of London. I've done quite a lot. Well, when I say quite a lot, maybe 5% of my total investment in England was outside of London. It was like in the north, and you used to buy all these little cheap boxes that were going to make you lots of money. And I'm sorry, but in my opinion, it's complete BS. the yields look really high, but after all the maintenance and hassle and whatever, it hasn't worked. So I tended to stick to London. And then when you take London, there's actually 3 areas. So you kind of got level 1, level 2, level 3. So level 1 tends to be like zone 1 properties. So that's like central London, might be Mayfair or whatever. They are very expensive. They've got very low yields, and they tend to only really go up in value based on capital growth. So that's kind of that focus. On the other side, kind of level 3, they tend to be the more crappy areas. And again, you're supposed to get, really good rentals and good yields, but you tend to not get very good capital growth. And also when you have economic slumps, then those markets are the ones hit hardest, just in terms of rentals and whether renters can pay and all of that stuff. So I've always stuck in the middle. So for me, I like sort of in London terms, zone 2 and zone 3. So let's give you a bit of a lesson here in UK property. So I'm looking for London tube map. So I'll share my screen with you here quickly. It was so interesting because this stuff for me is pretty easy. But Alex the other night was like, oh, wow, we should do a whole webinar just on this. Okay, so if you take the tube map, what you can see here, because I like this because it's the easiest. So if you can see this white thing here, you can can you guys all see my mouse, basically? You can sort of see my mouse going around here. So this in central London is called zone 1, okay? Then you've got zone 2, which is this more gray area around the outside here, okay? And then you've got zone 3. Okay, you're kind of with me. Now, what I just said to you, central London's zone 1. I haven't to date done anything in central London. It was always very expensive and, like I said, quite low yields. And from my personal, belief system, whether it's right or wrong, I don't know. I've always tried to focus on zone 2 and zone 3. So if you look here, we did a huge amount in Wimbledon. So Wimbledon. Come on, Wimbledon, where are you? There's Wimbledon there. In zone 3. So I've done a huge amount in Wimbledon Park, Southfields, Putney, this whole southwest London. Like when I lived in Wimbledon, there were a million South Africans living in London, and there were 60,000 living in Wimbledon alone, just to put in perspective. So it was a very good captive tenant market. By the way, the South Africans also lived out in the east. So around this whole area here, also zone 2. I know particularly the Afrikaans guys did really well out in this area here in terms of that process. We also did a lot in Canary Wharf. So you can see all of this area here around Canary Wharf and sort of Greenwich, North Greenwich. So you can see it's kind of a general strategy, kind of zone 2, zone 3 in terms of that process. Now, why I like this particular property is that it pretty much fulfills on my thesis. Because there the property's sitting, so it's in North Acton. Again, I'm hoping you can all see my mouse. I'm just going to make sure I can see on the chat whether you can see my mouse. But basically, you're sitting here in North Acton. So it's on the border between zone 2 and zone 3. Can I just check? Can you all see my mouse? You can just let me know in the chat box if you can see it. Okay, you can. Okay, great. So what I really like about this, I stayed, I'm going to go and show you from Google Maps where we stayed, but I couldn't believe how convenient this was into the city. So, like, if you go Oxford Circus, okay, here, it was 16 minutes from there to there, Oxford Circus. If you go Bank and St. Paul's, like, this is the old, this is the heart of the banking city. You're talking sort of 20 minutes. You've got Notting Hill Gate, you've got Bond Street. So the Central Line is in my opinion, one of the best tube lines. It runs all the time. There's a tube going every 2 minutes. And so what's also interesting is that you before any sort of fork. So as an example, if you live up here, every time a tube comes, some will go this way and some will go this way. It's a pain in the ass. Whereas every single tube on the Central Line will go through North Acton. Now, I don't know if I'm teaching you stuff you already know or if I'm teaching stuff you've never heard of, but location and transport is absolutely critical. So I really like this because it was super easy. Like I went down to my property in Wimbledon. It was super easy for me, like straight in the city, straight on the district line, straight down to Wimbledon. To get into the city, super easy. It was really, really easy to get around. And I stayed in a hotel, and I'm now going to go to the next slide over here. Okay, so there's North Acton Tube Station. So that's the one I just showed you that was on the Central Line. Now, I stayed in this hotel here, the Holiday Inn, London West. So when we did the buyers trip, this is where everyone stayed. Okay, so it was maybe a walk of 2 minutes from there to there. This hotel was packed. I was there for a whole week. It was packed every single night with different tourists, all foreign tourists. So there were Germans the one night, there were Chinese the one night, there were a bunch of Frenchmen on the weekend because the English were playing France at rugby. And I found it absolutely fascinating that everyone was staying here, even though they're playing rugby at Twickenham. And the logic for me was it was affordable and it was really easy to get in the city. Are you with me so far? Like literally, that was my experience on the ground. Now, to put in perspective, there's the tube station, and here's the building we're looking at, 1 West Point. It's even closer. It's literally like a minute's walk. So, I mean, that's the building there, 1 West Point. So I'll come back to the building just now, but let's stay on location. So if we zoom out a bit, okay, just remembering, there's 1 West Point. So you with me so far? I think if I'll put a little red marker on it so you can't lose it now, okay? So if I come out now, there we got 1 West Point, and then here is the biggest train station being built in Europe. So this whole train station here is the biggest train station being built in Europe, and it's called Old Mill. Where's the name gone? Anyway, this is this massive tube station that's being built. And I mean, this line there, it's Old Oak. That's what it's called, Old Oak. And this is going to be a railway line into Birmingham. It's going to have all of the different tubes coming into it. It's got 12 different platforms. And again, it's not even, it's about 7 minutes walk from here to here. Okay, so you're going to be within 7 minutes walk of the biggest station in Europe. Okay, now admittedly, this only comes on in 2027. So it's still 2 or 3 years away. And if you know anything about England, they're always late with when they deliver their transport. So if they say 2027, it might be 28 or even 29. But the beauty is, this is a value add because you've already got the tube station. So I'm not waiting. I don't have transport. Then the next thing is, if you go down to here, and you can see Acton Central. So again, this is about a 10-minute walk. And this has the Elizabeth line. So this is the new tube that came out in the last 6 or 7 years. Now this takes you straight through to Canary Wharf in 16 minutes. It takes you through to Heathrow Airport in 12 minutes. And now you're starting to see why that hotel was really popular. Can you see how easy it was to get around? Now again, this exists and it's 10 minutes. Now, when I bought property, and I've specialized mainly in Wimbledon and Southwest and the Canary Wharf side, I always believed in the rule of 10 minutes. So my whole philosophy was you need to be able to get off a tube and walk to your house within 10 minutes without being including a bus. Again, my own personal experience, buses are late, they're delayed, you come home from work, it's pissing with rain. The last thing you feel like doing is hanging around waiting for a bus, so you tend to walk. And the moment it's over 10 minutes, you battle to find a tenant and or a buyer of your house. That's my experience. So I called it the rule of 10 minutes. So this Acton Central is pretty much on that kind of that threshold of 10 minutes. But I mean, you can literally live here and you can commute into the city. You can commute right across the city to Canary Wharf in 16 minutes. It's actually quite phenomenal in terms of. So the first thing that I was blown away by was how much transport was in the area that already exists. And then secondly, what is actually coming. Then if I zoom back in, all of this building, so let me just, again, orientate myself. So I was staying here. This whole piece of land here, this whole empty piece of land is a big new development. This is a big new development. There's tall buildings going up all the way around here, high-rise buildings, okay, which is really important. And then this piece of land here, so you can see here, literally, this big piece of grey land here is Carphone Warehouse is head office. So Carphone Warehouse is a massive cell phone company. And they just sold this piece of land for £100 million, and they've sold it to the university. So I'm going to take you through in terms of the university. It's the third biggest university in England after Oxford and Cambridge, and they're putting a £1.1 billion facility, so campus, on this piece of land. you basically don't get closer. It's over the road. It's literally like over the road. It's unbelievable. Okay, now again, what drives British property? Like, does anyone want to give it a go? Like, yes, you got supply and demand. I'm talking mainly for foreign investors, actually, if I'm going to be a little bit more specific. So, yes, you got supply and demand. Yes, you got transport. That's for everyone that lives, in England. But if it's overseas, and I suppose even local, what drives property prices? Access to good universities. So like if you're living in Southeast Asia or Dubai or Africa or somewhere else, and you're sending your children over, not only is this going to make this property extremely valuable because it's literally right next to Imperial College, but also for tenants. And you're not dealing with lower class kind of students. You're dealing with, parents that can pay for their kids to go to overseas university. I don't know if you know this, but if you're an overseas student, you pay 3 times more than a British kid. So you're dealing with affluent people, and affluent people want their children to live in affluent accommodation. So are you starting to get a feel for the location and kind of what's happening in the area? Yes or no? Okay, now let's go a bit further. So if I zoom out again a little bit, and I can't, it's easier for me to do it on the other map, but I'm going to give it my best shot. Within this area, and I'm embarrassed, I don't even know which direction it's in, but I think it's over here. There are Google data centers being built. So it's the biggest Google data center in England. $1.2 billion is being invested. And it's here somewhere. I don't know, it might be here. It's somewhere here in this area here. Okay. So like there's so much transport, so much infrastructure. And this whole area is what's called a regeneration area. So there's this massive movement and growth. It used to be an industrial kind of warehouses, etc. And now it's got all of these facilities. So this is the building. It already exists. There's 4 towers. There's 770 units. The developer's keeping 420 of them for themselves. And so just to put in perspective, this is the building. This tall building is a building called Icon. So we're investing in this building. It already exists. I've stood on that roof. I wish I could say I'd been in that jacuzzi, but I haven't. But I've been on that roof. And that is car phone warehouse right there. I'm going to look at the chat box to see if anyone else is writing wow. But it's literally like over the road. Okay, like that is all these. I know they don't look very tall now because this is but look at all these tall buildings that are being built all around here in terms of this precinct. So they're basically doing what happened in Canary Wharf. And if I could go a little bit further to the right, Imperial College has a campus here. So let's just look at a couple of the pictures here. That's the courtyard on the inside. I mean, everything exists. So if you look here, I can't quite see it. It's behind this building here, but Imperial College is like right here. So it's a triangle building, and you'll see it. It's coming up just now in terms of the slides. This is just some interiors. This is the gym. It's a massive gym. It's an entire floor just of gym. You've got supermarkets. You've got coffee shops. So they've gone very much for lifestyle in terms of the overall process. This is a roof garden with where you can sort of sit outside. So this is just a feel for the apartments on the inside. You've got a mixture of 1 and 2 bed apartments, but I mean the views are to die for. You can literally see out over the whole of London. You can see all the way to Dover, believe it or not, on the coast. When I was there, the people on the buyer's trip didn't experience great views, but I'd been there 2 times before that. So that's the tower, Icon Tower. They originally had planning for 42 stories, and then during COVID, they managed to get planning for an extra 12. So it's actually 54 stories, and it's the highest building outside of Canary Wharf. So the highest building. You don't need to see all the plans. Okay, I just want to see if there's anything else I want to show you here quickly. So there's no, I'm literally going through the website. So I just wanted to give you, yeah. So there's Imperial College. So that was the triangle building I was trying to tell you about. And as I said to you, they're investing 1.2 billion. They are the third best university. Some would say better than Oxford and Cambridge, but obviously Oxford and Cambridge are far well better known. But they are more capitalized, which I find very interesting. They got more money than Oxford and Cambridge in terms of the process. So this is that whole new precinct that's being built. This is the new train station. So the one I told you about with the 12 different platforms. Obviously, this is architectural. It doesn't exist yet. But you can see what it's going to look like when it's finished. You can also see it's called Old Oak Common, but you can see the like all of the infrastructure. Now, this is 7 minutes from the building. So it's this, this super hub, as they're calling it, in terms of the process. This is what it's going to look like in terms of the whole area, so the precinct that they're working on. Now, I know this all looks a bit futuristic. I was on the ground. I don't know how well you do or don't know Canary Wharf, but I was on the ground building in Canary Wharf in the early 2000s, like 2000, 2001. And everyone, like I used to see these things and rivers and bridges, and you think it's all a bunch of bullshit until it actually happens. And so I've seen a regeneration area in Canary Wharf go. And with that, property went through the roof. I've told you about the investors we helped in City Peninsula, which is North Greenwich. We bought for between 250 and 400,000 pounds, and we were selling for over £1 million, just to put in perspective. So 3 times growth because it was in a regeneration area. So again, there's Old Oak Common. And then this is that whole development area that's being built. There's North Acton, which I was telling you about, which is on the Elizabethan line. And then you basically got, their building is right in this precinct here in terms of that plan. Okay, I think that's probably enough. I just want to see if there's anything else that I should show you here. Okay, so what I want to show you now is, so that's the tower. I want to show you this video quickly. Now, I know when I played this video for the mastermind, they said they couldn't hear the volume. So just forget about the volume. In fact, I'm not even going to play the volume because apparently it didn't come through. So you can just watch the video. Let me just stop there. That's the train station. So that Old Oak Commons. Look at all the cranes and the infrastructure that's happening. And I mean, you can see it's 7-minute walk, but it's literally, I mean, it's unbelievable what's happening here. As I said to you, it will be finished in 2027. This is the Elizabeth line coming through here, and the North Acton, not North Acton, Acton Central is literally here. But I mean, you could throw a stone onto this train station from the building. Okay, so I think you've got an idea of the building, the location. Now let's go to the developer himself. So I've worked with Gary since 2007, so I've known him for a long time, Gary and Ian from City and Docklands. When I first met him, they were doing what every developer did, which was build stuff and sell it. And they actually made a lot of money. And if you haven't watched it, I'd highly recommend you go and watch the recording. If anyone hasn't watched it, just let me know. And I'll share with you the recording where I did a one-to-one with Gary, both for the mastermind and in the challenge. And he spoke about how his background was he came from furniture packs. So his dad had a furniture company. And so when developers sold units, he would sell furniture packs. And then basically they offered a rental guarantee. And then they started a management company called Life Residential, which became the biggest privately owned residential company in London. They were the biggest private landlord in London. They sold that to Dexter's about 2 years ago. And then he basically became a developer himself. And what was really interesting is that a couple of years ago, maybe 2 years ago, 3 years ago, there was a very wealthy gentleman called Ben. I'm not going to mention his surname because he doesn't like to be in the limelight. He's worth £500 million, all in property, no mortgages. So 3 generations of property in the family. And I was walking around London. I had the most fascinating buyer's trip with him. And I said, where would you invest right now? I mean, remember, we were in the middle of COVID and all that stuff. And he said, residential property. Like he's got industrial, he's got commercial, but he's in residential. And I was like, okay, that's interesting. But he said, I just want to be clear. I'm not going and buying little flat here and a house there and whatever. Like I want to buy like whole buildings, like if that makes sense, which is why I keep talking about institutional investing in residential. And anyway, so I said to Ben, well, great. Like, how can we partner with you? You know how my brain operates. And he literally was like, no, well, you should meet my friend, Gary, that's a developer. And he's tired of building and selling. He's now building and holding. And, maybe you've got with your platform, you could invest alongside him. So I was like, perfect. Well, who's your friend? He said, no, it's Gary, Gary Sachs. And I was like, no way. It's like I was selling Gary Sachs's buildings in 2007, to put it in perspective, like literally nearly 20 years ago. So I connected with Gary. And for about 18 months, we've gone back and forth of like how we could actually do this. And that's actually why I got an airplane, flew to London. Because what we're going to do is we're going to provide people with both options. Like they can do it the older traditional way. And if they want to buy a property and get a mortgage and own it themselves, they can do that. And then secondly, we're going to fractionalize it where we're going to take 5, although we're aiming for 10. And we take 10 units. We get a discount because you always get a buyer's discount if you buy 10 in bulk. We get a discount. We partner with Gary. Ideally, we get financing with Gary because he's got a much stronger balance sheet than we do. And then we own the units with him. They've got a full management solution and we own it. Now, people say to me, how long are you going to own it for? Normally, traditionally, we would say an investment would be 5 years. In this case, I don't want to say 5 years. So what we're going to say is we'll say 5 years. We'll find an exit for people after 5 years. But I want to be very clear. Our intention would be to hold it for 10, 15, 20 years because you've got to wait for that train station to be working and that whole area. Like if again, I've witnessed this. It's hard to explain if you haven't witnessed it. But with Canary Wharf, like it doesn't happen in 3, 4, 5 years. It happens in 10 years and 20 years, if that makes sense. That's when you get 3, 4 times your money. So I just want people to know that if I go into this, it's certainly in my mind, it's a buy and hold. But we will create liquidity events where like if someone wants to sell out, I don't know, Shona wants to sell her share and Frankie wants to buy in, well, then we'll facilitate that. But we're not actually going to sell the property, if that makes sense. And probably the thing that gives me more confidence than anything is the man has built 770 units and he's keeping 420 for himself. Like, I don't know what else to say to you. Like, the guy knows more about London property than anyone I've met. And, he's chosen to hold. So, that's probably it. I don't know if you've got any questions, Craig, or whoever else asked about the London stuff. But I mean, that for me would be my kind of synopsis on what I found on the ground. I know I sound like a salesman now, so take it whichever way you want. I was excited about this opportunity before I went there. I was 3 times more excited when I was there, when I actually realized how close the transport was, how convenient it was to get in the city, when I could see with my eyes what was happening around the area. I've got lots of videos if you haven't seen them. And it's really hard to explain that. There were 20 of us on the buyer's trip. it's really hard to explain what we found on the ground. Like the brochures don't do it justice, and I don't quite know how to do it. I'll be honest with you. Other than what I experienced on the ground. So, like I said, I know I sound like a salesman, but I'm super excited. We had a meeting. My business partner that started Wealth Migrate with me, Jaco Maritz. We're putting all the modeling together as we speak. We're putting a proposal back to Gary and Ian to do the tranche and everything else. So we're working as fast as we can. But there is one caveat, and I say this to you with a smile on my face. These are old school developers. Like they've done it one way for 20, 30 years, and now we come into them going, we're going to buy 10 units and fractionalize it. And they're like, so it takes a bit of time to kind of get someone up to speed on a new process. But they very much are open to it. And the other thing that's a good thing is that if the market was pumping, and the market is not pumping, so it's definitely a buyer's market. If they could go to Hong Kong and sell 120 units on the weekend, they would, and they wouldn't give a shit about us. I just want to be very clear, okay? But the timing of the market's perfect because it's not that easy at the moment. England's going through its own troubles, and there's uncertainty and whatever. It's like perfect, awesome time to go in and negotiate. So I actually see it as a bonus, So yeah, Craig, I don't know. I mean, I've shared everything I know so far. In terms of the models and the numbers and everything, we're working on that. I think the biggest caveat, we were doing the modeling today's Friday, on Wednesday. And most people can borrow buy-to-let now somewhere between 6.5% and 6.8%. I don't know if you'd agree with me, Craig. I know you're on the ground, but we actually had a mortgage broker come and speak to us on that Friday when we were there. And he pretty much said, buy-to-let, whether you're a foreigner or not, you're looking at about 6.5% to 6.8%. At a 50% loan to value, you're going to struggle to break even, which is, that's a problem. At a 4.5%, 5%, you're breaking even, and anything below that is all upside. Okay. So if I go and try and borrow, I'm being facetious. Craig and I try to go and borrow ourselves. We're going to borrow at 6.5%, 6.8%. Whereas if we can leverage off Gary's balance sheet and partner with him, and if we can borrow at, I don't want to make up a number because I don't know, but I mean, he's got a 10-year fix at 0.7%, just to put it in perspective. If you can get anywhere near 3 or 4, then it makes a big difference. Something I didn't mention, which is important, the entire building is tenanted. The entire building's tenanted, and it's got 98% occupancy. I mean, that's sort of unheard of. Like, that's literally like someone's arriving, someone's leaving type thing. And that shows you again back to that location. And I must admit, even if I thought their numbers were bullshit, my hotel was packed. I'm sorry, I'm going to keep coming back to the hotel thing, but like, that speaks volumes for me because I just saw that with my own eyes. It was pumping. That hotel was pumping. And the only reason I can assume it was pumping was because it was affordable and it was seriously good location in terms of transport. So I don't know. Any other questions? Anything that I can help with? Neil said, yeah, what yield do you anticipate for this London? Best guesstimate, obviously. What rough timing do you think? So yeah, Niels, the yield is a really hard one. So the gross yield is around between 3.5% to 4.5%, which is pretty stock standard. I wouldn't be surprised, Alan, if you're getting that in your London apartment. Although you're more central London, so it might be even a little bit less. So, and that's where, to try and answer Niels' question, what's more important is not the yield, but the cash on cash. So if I put in $100, how much is it actually paying me in my pocket? My guesstimation at the moment, because interest rates are higher, it's going to be fairly cash flow neutral in the beginning. And we're going to have to hold, it's going to be fairly cash flow neutral. And obviously we're banking on the capital growth. And then we're also banking on the fact that rent escalations, so all of their rental contracts are pegged at 3%. So their logic is within 2 years, you're going to start to see nice rental growth, plus interest rates coming down, and that gap will provide the cash on cash. But in the short term, my prediction for the next 12 to 18 months, it'll be fairly, like, we'll do the modeling to get it to cash flow neutral would be my first aim. And then, but as I say, this is a longer term hold. What rough timing do you think we're working towards? That is a seriously difficult question to answer because it depends. Everything comes back to this financing, and how quickly, whether Gary can get his bank to help us or not. But certainly we are very keen. If I could do it tomorrow, we would do it. But I mean, we're on it as fast as we can, Niels, if that's answering your question. But I would say in the next probably a month or two, as quick as we can. If we can get sellers finance, which is where we partner directly with Gary, then ideally we don't even go through a bank, and then things can happen a lot quicker.
So Scott, just educate me. If you invested, for instance, say £900,000 in London, what should you be getting after costs and then the net profit on a flat like that, 900,000 invested?
So let me show you here quickly. Just give me 2 seconds. I want to get it for you.
And what would you get in Manhattan?
So in Manhattan, if you do the blend, you're getting 6, whatever that number was. I think it was 6.6% cash on cash. So Alan, what I would do, so this is a model that I built years ago, and it's how I did all my property investing in England. And so what you would be looking at, so just to put in perspective with yourself, I can literally go and just save another one. So let's just go and save it here. So you said 900. Do you have any idea what your gross rent is at the moment?
My gross rent?
Yeah.
£2,900.
You know what your interest rate is?
No interest. I don't own anything on it.
Okay. So you can see that. So you can see it's calculating straight away for you. So your gross interest is 3.87%. Sorry, your gross yield. Okay. Remember, it'll be a little bit less because you're in central London. Okay. On this side, I don't know your exact numbers, but there would normally be like a homeowners association or there'd be rates, etc. So I don't know exactly what your numbers would be, but it's easy. I mean, one can populate this in terms of the process. But if you go down here and you look at it now, this property should be net, or actually it depends on your management. How much are your management fees at the moment?
Fuck. I'll have to send them to you. Terrific. What's going on there?
So City and Docklands, what we're negotiating with them is 10%. The market related London one is generally 15%. So you're probably somewhere between 15 and 17%. And you'll look at the impact. But in simple terms, your property should be earning you about £20,000, give or take. I don't know the exact rates and taxes and whatever, but your property should be earning you about £20,000.
At the end of the year, I should get out after a year £20,000 on that property.
Plus minus. I mean, I'm not.
Yeah, no, sure. I mean,
there's obviously nuances around your rates, and I'd need to know those exact numbers. But I mean, if you gave me those numbers, I could populate that spreadsheet for you quickly.
Okay, I'll do it at the conference.
And then what's also useful for you, so because what I can do once I've got the numbers, I can also then go in and say, well, if you're getting 5% capital growth, then that would be your annual return. If you're getting 9%, then that's what it'd be. If you're getting 15%, then that's what it'd be. I can also do it to show the rand return, which is valuable. And then lastly, you could also say, well, if I was to gear that property, so I know you're thinking of selling it, but if you just geared it at 50%, then it would be what's going on? Oh, it's the interest rate, 6.5%. And you'd see now that property would actually be negative. It would cost you £7,500 a year if interest rates were 6.5% and if you were geared at 50%. But yeah, I can help you with this. I mean, if you come up when I see you face to face, because what becomes very valuable is that there's 3 scenarios that you have here. One is you sell the property and you deploy that capital somewhere else and get a far better return. So that's the one option. Okay. The second option is you keep the property and as is, you just keep it and you hold it. Okay. And then the third one is the one in the middle where maybe you take 50% out of the property or even 20% or 30% or 40%. But you want to, obviously, I would assume you want to keep it cash flow neutral in terms of that process. So, but I mean, I can help you with that modeling because it's never as easy as
No.
This or should you do this? It ultimately comes down to in comparison to what. So if you've got £900,000 sitting there and it's earning you 3.87% gross, which take off costs means it'll be netting you about 2% plus minus. If you compare that to something else and maybe you're getting 6 or 7 or 8%, that's 3 times your money, huh? Just to put in perspective.
Okay, good. Thank you.
Cool, no problem. Cheers, Niels. Yeah, no, I can see we're actually on the hour, so I hope this helps. And Alan, thanks for that question. Because I think these models and stuff, this calculator, and I think most of you are getting to know me a little bit better. I don't like things that are super fancy. So I always say to people, this calculator might be, I don't know, 95% accurate. I guarantee it's not 100% accurate. But what I love about it is it's all on one page. So the green is where you put in the variables. It gives you your total. Obviously, this is if you're buying it up front, but it also works for Alan that already owns it. You can see what do you need in cash up front. What do you need to set it up? What is your cash flow? If interest rates go down 2%, if it's at the current one or up, what's your capital growth based on 3 different scenarios? And then even for the South Africans, it's got a rand devaluation. Now, it does have all the long-term calculations over 25 years, and it's got all these kind of fancy graphs. But no one needs to know about that. It's on the front end that becomes important. And why I like this is it just helps me to compare apples with oranges. Because I can literally put a house in, I can put Shona's house in North England somewhere, and I can put a London property in, and I can put an American property in, and boom, I can see the difference between the 3. Does that make sense?
Yeah. Please, thank you.
Cool. Awesome. Okay, man. Well, it looks like everyone needs to bounce anyway. Me too. Just for the record, it's a beautiful day here. It's actually overcast, but still very warm. And I've been in England for 2 weeks. I was 1 week in England, and then I was in Joburg, and then in Cape Town. So I've only been home for 2 or 3 days. And I tell you what, if you ever want to be grateful for where you live, just go to London for a week. And Joburg, for that matter. Anyway, thank you, everyone. Have a wonderful weekend. And Alan, and to the rest of you, if you can make the Wild Weekend, I would highly recommend it. I think it's going to be a very unique experience. Yeah, come join us.
I'll be there.
Cool. Awesome, everyone. Cheers. Bye then.